The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Money never sleeps, pal.
So, morning, Gareth. It's
Morning.
Friday, the 19th of January.
It is.
We're here to talk about what happened this week in markets, but we also have a special guest. So, joining us today to tell us about the Deutsche Numis Indices is Scott Evans. I'm delighted to say he's here today to talk us through what the Deutsche Numis Indices actually are and what they tell us about the UK stock market. Over to you, Scott.
Well, thanks very much, Jeremy and Gareth, and it's good to be here. Yes, so the Deutsche Numis Indices, probably best if I give you a little bit of background to it, what they are, their background, and who use them and why they're important, actually, and actually what they say about the UK equity market. So very, very quickly, they were launched actually in 1987, and they were launched by Horgevet. And they were designed and managed by Professors Paul Marsh and Elroy Dimpson of London Business School, who I work with. At the launch, the main index actually was the Horgevet Smaller Companies Index, and that's been probably one of the most well-known small cap indices. Since Numis, and now Deutsche Numis, acquired the business, we've expanded it from covering not just the smaller end of the market, it's now a complete set of benchmarks. And that's the important thing, is benchmarks that investors use to track and manage and look at the performance of their funds. We produce them daily. They've got a back history to 1955, so they've got a very, very long history compared to other indices. I will skirt across that today because it's not everyone's cup of tea. And I'm actually going to try and minimize talking about any of the names because the names of the indices have now got quite long because they acquired an N with Numis and then they've acquired a D with Deutsche. So now everything is DNSCIXIC and things like that. So I will avoid the actual names and just sort of try and talk about the small cap, mid cap.
So small, medium, large is sort of maybe
small, medium, and large, yes, because there's all one of the things which is important and we talk about a lot, and for most people it would be quite dull, is that what the indices have always done, apart from being very long run and they cover the whole market, we always separated out. We did this before FTSE did it. Investment companies or investment trusts. Just as a reminder, the small cap indices, which is what most people look at in terms of our indices, they're not based on numbers. So, unlike FTSE, which has the FTSE 250, FTSE 100, and then the remainder of the all share becomes small cap. So it's numbers. We do it on percentage of market. So the smaller companies index is the bottom 10% of the main market, and the large cap index is based on the companies that make up 80% of the market capitalization. So it's always about the percentage of the market, and that's actually very important in terms of one of the highlights this year in terms of the shrinkage of the market. And I think this has been picked up in the press a lot over the last few years in terms of lack of IPOs, concentration of the market. And hopefully, if we have time, we can go through that in a little bit more detail. Very, very quick rundown in terms of the highlights in terms of performance, because most people know this is backward looking, so they'll know what that is. But then maybe we can just pick up some of the more interesting, I think, elements which came out of 2023. So just in terms of index performance, this year was obviously a lot better than the year before. When I was doing this last year, it was been a disaster. Only the top largest companies have actually managed a positive performance. Everything else had underperformed. This year's better. If you're a small cap investor, small caps actually outperformed larger caps marginally. All of the indices were in a positive territory by the end of the year, apart from AIM. And that's maybe something we can discuss in a bit more detail. AIM's at its third really poor year of performance at the total market level.
You bias against it in that sense, don't you? I'm not sure.
It's an interesting question and something we've looked at in terms of selection bias, especially within the indices in general. And what the answer to that could be, well, you could say the same thing for the UK market in general. Yes. You had ARM, and obviously ARM was the big technology sector of the UK, and that disappeared. You have the same thing in terms of when you rebalance the indices, which we do every year in terms of to bring in the new companies and to get it back to where it should be after there's been acquisitions, etc. And what what we haven't found, funny enough, and it's something which I had exactly the same view as you. We've generally not found there's been this selection bias. With AIM, quite often, yes, some of the bigger companies, they go private, okay, so they list elsewhere, but that's becoming the same now for the main market. As we know, we've seen a few very large companies leaving the successful UK companies and listing in the US, and we've seen that. For AIM, they've had an element of that, but the number of companies that have, say, transferred from AIM or been very successful and transfer from AIM to the main market, which would be an obvious choice of where the selection bias would hurt. They haven't performed any better on the main market as they would have been on AIM.
But in essence, 2022 was an awful year for everybody, but particularly bad for smaller companies rather than larger companies. 2023, you've had to wait till towards the end of the year, but smaller companies have come back with a vengeance and outperformed, in the UK at least, mainly, have outperformed larger companies. So what we're perhaps interested in, this smaller companies effect, the signs of life there. Is that fair to say?
I think there's absolutely. And so for the UK, small caps did outperform larger companies once you strip out all the investment companies. And 2022 was very, very different. And as I said at the beginning, it was really only the mega caps that you had. It was only the oil and financials that they did well and everything else did badly. This year my intro to the annual review this year was that if you wanted to characterize last year in terms of performance, it was like some Victorian era novel. Actually, I was pointing to Dickens at the time, as in, good start, really arduous and difficult middle, and a very racy ending. And that's what happened. I mean, all the performance was not so much for mid-cap, but all of the performance came in the last 2 months. Before that, small caps have been underperforming. Large caps sort of they trundled along. Or it could be sort of like the tortoise and the hare, but slightly in reverse, as in the hare sort of won in the end. But overall, small caps did outperform. And I think this is the really important point to make. One of the things that we do and the nerdy stuff about the indices is our long run performance. And the reason it was launched in 1987 was because of the size premium, the positive size premium that had been identified in the US. And it had been shown that US smaller companies had significantly outperformed larger companies over the long run. Hence why the Hawk Evett Smaller Companies Index was launched and why it then became the Deutsche Numis Indices. And we found, looking at all of the analysis back to 1955, smaller companies had, on average, outperformed large caps. Not every year, sometimes they underperform, but longer term. And that is still the same now. Going back the 69-year history of our data and our indices, the annualized outperformance of small cap over large cap is about 3%. Now, that may not seem that stunning, but that is over the longer term. And there's some really some charts that we like to show every year in terms of what's been the longer term performance of small caps versus large caps. And I think if anybody here is listening and they think, well, it hasn't been so great in recent years. Well, here's a few little statistics. And I did say I wasn't going to do statistics, but I'm sorry, I'm a statistician, so you're going to have some. If you're just looking at the longer term, and total returns is what we look at, and by that means looking at the capital gain and adding in your dividend as well. And dividends are very, very important when it comes to long-run investment. If you'd invested £1 in the large cap index in 1955, your total return over the 69 years, you would get £1,357 now. That's how much you have got back. So that's not bad. Now, if you'd have gone, let's have some mid caps, and you're done into mid caps, you'd actually be, your £1 would today, this is nominal, this is not in real, but I can give you some of the real statistics as well, taking into account inflation. You'd have £4,159. So that's looking better. Small caps, that would actually be, your £1 would be worth almost 9,200. But if you'd invested into the real small caps, and this is the bottom 2% of the market, so they're not tiny companies, but they're the bottom end of the Deutsche Numis Index. And remember, the average size in there is around about 400 million. You would have had if you'd have invested in the real small caps, which is now the DNSC 1000 XIC index, and it rolls
Trips off the tongue.
Trips off the tongue. Yeah. You would have £22,572. So over the longer term, small cap performance has been extremely strong. So that's what that 3%
performance. So it's about 30 or 40 times what you would get just in large cap over that period.
Absolutely. So, you would have had over the longer term, you would have had a substantial return. Over the longer term, it's not government bonds, it's not houses, it's not large cap. It is investing in the smaller end of the market that has generated by far the best returns, both in terms of the equity market and in terms of other assets.
I wonder if I could ask Scott to go back to your analogy of the novel and the steamy, exciting bit at the end, and just trying to work out how much of that can persist into 2024. Is there a view of how much of that performance in sort of effectively Q4 of 2023, how much of that was driven by M&A and the takeout premium that we saw, and how much of it is of genuine underlying recovery or stronger performance across the board in that small cap part of the market?
Okay, very good question. And one of the things that we do we track all births and deaths that come into the market. We look at the premiums and we look at what's happened. And funny enough, most of the action in acquisitions and takeouts last year was within AIM. I think there's 52 companies were acquired, but that's completed. And there's probably about another 30 or 40 which are in discussions. But nearly all of that was in AIM. And it actually had a relatively small impact on AIM's performance. And so I think, to answer your question, and I haven't got the exact details, but it's something which we do calculate, most of the performance and the turnaround came in the market in terms of inflation expectations, rate expectations, and you had the stunning performance, especially in the technology sector, the Magnificent Seven in the US, for example. That's why the US was a stunning market last year, 26% return. I think, exactly what I thought. How much of this is being driven by companies being acquired? And I think it was much more a macro US interest rate, inflation. That's what really drove the last 2 months of racy performance in my Victorian novel. There's another important element there, and I think it goes to it, is in terms of small caps had almost been written off during the year. Mid caps had a better time, but mid caps are much more of a barometer of the economy.
The AIM index during the year reached a low, including COVID, very close to it, whereas all other indices were quite some way above the COVID low.
AIM from peak to trough was down 20% at one point. So it really had a difficult time. It did try to stage a recovery towards the end, but that actually may well be exactly what Gareth just said in terms of there was a bit of a bid premium, because that's really when technology was a very, very poor performing sector, industry, or however you want to classify it, for AIM. Everyone's been looking at mega caps, and that's what was driving the market. It drove it in 2002, and it was driving it in the US, as you've already said. But there was definitely a return to favour in small cap in the last part of the year. And whether that continues, who knows? We had a very good start. All of the small cap indices started incredibly well in January 2023. But then we had all sorts of issues: conflict, interest rates, inflation becoming, we thought it'd been tamed and it hadn't. So there was a lot of in October, especially with conflict in the Middle East, that had a real knock-on impact across the markets.
And of course, we started last year with everyone expecting a recession, and we're beginning this year with everyone expecting a dramatic fall in rates. The recession didn't happen, and one has to wonder how dramatic the fall in rates will be if and when it comes. So.
Yes, I've been discussing this in detail, and I think that the news which we're seeing now is that, and I think the consensus has become that rate cutting in the short term is not really going to happen. You're going to wait until probably the middle of the year until you start to see anything. Even though we are in election years, both in the UK and the US, the what's coming, and you saw the IMF report this week basically saying, please don't cut your rates. It's not the time to do it. And I don't know how much central banks listen to the IMF, but hopefully they do listen to them.
Or how much the bond market listens to the central banks. I think that's the issue.
I only do comparisons of bonds. I don't do analysis of bonds.
It's a good opportunity maybe just to morph onto what have been in the last week the main, and you touched on a few of them there, Scott. What have been the main sort of macro drivers, influences on the market? And the one that, I just keep coming back to and keeping an eye on is the oil price, which particularly in the context of the militant activity in the Red Sea, we haven't seen a spike in the oil price as a result of that, which tells me the implication I draw from that is that whatever you think of the politics of the situation or the human tragedy, which is undeniable, the impact of this is largely regional still. And okay, we've got some supply chains delays. Shipping from China to Europe is taking longer, but the actual impact, there's a lot of talk about stubborn inflation and a lot of it and blaming it on military action, but the oil price isn't telling you that. And normally you would see, obviously the dollar going up. Well, the dollar has firmed, as people go for a safe haven. But you would normally expect, if people were concerned that this would become more of a regional conflict with wider implications, that we'd be having oil well above $90 a barrel, and it's still, last time I checked, below 80.
Yeah.
So inflation is definitely proving, despite that, inflation is proving stickier than we thought before Christmas.
I think inflation remains. It is. I mean, we've seen historically inflation. It's pretty hard to tame inflation, especially when you have wage growth the way it's been. But just going back to oil, and I think it's very important because the oil price has obviously been a big driver for the rest of the equity market as well. And it's something which I've been discussing a lot. So first of all, on oil, it's always about demand and supply. And you generally think, well, given conflict in the Middle East that we've seen that OPEC Plus has been trying heavily to restrict supply. You would assume that oil price was going to be being pushed upwards. And it hasn't. And I think there's a number of issues here. One is, obviously, you've got US supply. That has been significantly increased. You've had how strong OPEC Plus has been in its ability to reduce supply, I think has become relatively limited.
Well, not very, because Angola's left the party, haven't they?
Exactly. And the other thing is, how much is this about demand? This
is it. Absolutely. Yeah.
Is the global economy on the precipice? I'm not going to be on your show here saying yes, we're all going to hell in a handbasket, but
we're all going to hell in a handbasket.
But it seems to me to be saying that actually all of the elements are there for the oil price to be 20 or 30% higher than it is, but it's not.
I read something the other day. So one thing, with the election year, one of the things Joe Biden will not be boasting about is the US in 2023. If you include oil and all other related products they're getting out of the ground through fracking shale, 2023 they were the world's largest producer of oil ever of any country in the world, including Saudi Arabia. They are huge, and Saudi show every indication of almost giving up the ghost. Giving up the game, and I think that's a very interesting dynamic, and it's very interesting to see how it plays out.
Yeah.
But
we kind of made the point. We made the point. I think when we spoke last week as well, that as we move through 2024, and the prospect or the realization that Donald Trump could be our next president or could be their next president, that if anything will ensure that the production of oil in the US will continue or accelerate. So markets might ironically be reassured that could be a sort of a deflationary. Or abundance of energy at relatively low cost could be a good thing to reassure markets.
Yes. In the short term, I mean, the figures this week, despite wage growth moderation, UK inflation has gone up at the back end of last year, where everyone was thinking it was going to be flat or start going down. It's quite interesting. People, and I'd quote Capital Economics on this, was saying that with our slightly unusual energy price cap and the base combined with the base effects of high inflation in March and April last year, they're saying, and I don't think they're alone, the UK inflation can fall in March and April. It might be having a bit of a tough time at the moment, but it can fall so sharply that by April, they're saying it could be as low as 1.7% of the headline level, and below that being reported in Europe and the US, which would be extraordinary. I'd be very interested to see how the media cope with that one if it were to be true. It does point to quite a racy time in markets. If inflation at 1.7% and base rates at whatever it is, 5 and a bit percent, that could look quite tasty in terms of the downward trajectory of rates, combined with about that sort of time we're going to be getting the sort of pre-election budget as well.
Yeah. I mean, I think, obviously rates and expectations and inflation have been a big driver of equity market performance or financial market performance over the last couple of years. The UK, as you know, has got a pretty poor history when it comes to control of inflation,
No kidding.
especially from the 70s onwards. And I think the structure of the UK economy at the moment makes it a little bit more tricky to control it. But I totally what you've discussed, and I think this has been brought up as well in various other places. I know the Financial Times has been pushing it, that actually core inflation is probably could become a lot lower than headline inflation is currently predicting. And that may well be the case. And I think at that point, the Bank of England may have to, if that is with, we started seeing a pickup in unemployment and what have you, which at the moment we're not really seeing, we may start to see some fast rate cutting. If that was the case, that is a pretty good environment for small caps, as long as we're not going into recession. So it's a really, really tricky juggling act between rate cutting, inflation taming, and not going into recession. I mean, everyone thought the US was going to have a tricky time of it, and it massively outperformed. Possibly the UK may do the same thing.
Yeah. And interesting, just before we look at some more sort of company-specific news, there's a sort of a corporate angle or a quoted company angle around some of that, the risks or the challenges around the tragedy and the conflict in the Middle East at the moment. I was talking to a couple of companies during the course of this week, and their view on the supply chain risks. And I think a lot of people have been highlighting the fact, that journeys are taking longer, the ships are being diverted, and it's more expensive. And there are, I think it's about an extra 10 days in each direction that it's taking. The comments that I've heard from a couple of our clients have been actually companies that are exposed to this sort of supply chain, physical goods movement reality. They've been dealing with difficulties like this for the past 3 years, all through COVID, and then through that sort of challenging post-COVID sort of supply chain normalization. They've been juggling these difficulties and managing them for a very long time now. So it's not as if these new problems have come, yes, they've come out of the blue, but they've come on the back of similar types of problems over the last several quarters, or many quarters, in fact. So corporates, I think, have become probably better at juggling and managing that than they might have been 3 or 4 years ago, or certainly pre-COVID. Those things would have been a real challenge or a major shock. These days, companies have had to, sadly, get used to dealing with these difficulties a lot more frequently. So their view was that most businesses should be able to manage that additional disruption. So hopefully
I think that's a really, really interesting point, because we've talked about before that, this isn't what we're experiencing or coming out of, or the cycle that we're going through is not your normal. I'll hesitate to get too technical on the economics front with Scott on the line, but it's not your classic business cycle recession. It's more of a rolling recession, because we turned the economy off and we turned it back on at different times in different places. So, the question we've talked about is China just behind everyone else or ahead of anybody else, or is it cyclical or is it structural? But to come back to the component, the learning for companies, and that you just got to read RNSs every day to see that companies have learned, the good quality companies, and most listed companies are good quality businesses because they would, there's a selection bias in favor of them. They've come to learn about, very quickly, they have to learn and adapt to inflation, which most of them are saying in the UK is moderating, but component and shortages and supply chain issues. And one of the companies that updated this week that I keep an eye on is Concurrent Technologies, which is basically in 2023 missed a whole year because, sorry, am I saying 2023 or 2022? But has basically missed 12 months of production since due to component shortages. And in all that time, and the work that the Miles Adcock, the CEO, has been doing there to rebuild the business, they've been winning new contracts. And to put it into context, they make rugged computer boards largely for the defense industry. And of course, the defense industry, for reasons we know, we've talked about, is a growing market. They haven't, in terms of orders, they haven't lost a beat, but they haven't been able to deliver them because each board has several thousand components on it. And if you're missing one component, you can't ship the board. So 2023 has been a year of unwinding all that and turning a lot of stock into a lot of cash. as you say, it's something they've had to adapt to and seem to be now through that inflection point. What tells you that it's a valuable business is that throughout all that, despite being on 40-week lead times for their customers at one point, haven't lost a single order from what we can tell.
Yeah.
So, these companies are having to learn.
I think one other thing just to highlight, especially, and it was just one point to break out from the indices, that we do track the number of companies that leave the market and how many become valueless. And one of the things that has surprised me, during the COVID and the post-COVID period where we thought everything was terrible, the actual number of companies delisting because they became valueless has actually been very, very low. And we've had a few monster takeouts, and I know that there are ONS data talking about the number of companies going to administration is high, but a lot of these companies were shell or very, very tiny. So we haven't had this massive sort of companies all going into a liquidation. This year we had 22 companies in total that left the market valueless, but their total value was actually, which is historically...
Well, I must admit, that is surprisingly low. But I was going to say, in 2020 and 2021, going bust was made illegal, wasn't it? Because you couldn't go bust because they'd send you money.
Yeah.
So there's this. It's all part of this sort of excess savings, and it happened to companies as well as companies were cushioned. We were all cushioned.
Yeah.
And, part of the normalization of rates has got to be that cushion is either gone or is going. Yeah. So my fear is that those numbers are all going to, and I'm not sure, not talking necessarily about quoted companies because I think there's a selection bias, but corporate failure is going to hit the headlines again, I think, in 2024.
That'll be interesting. And that's something which we are monitoring.
Because as Ruffer has been saying, the only entities that can live at 5% interest rates are governments.
Yes. And in what have governments been doing? Governments or central banks have been providing a lot of liquidity over the last decade. And, well, it could continue forever. But then one day, as I always used to say, remember, increasing money supply generally meant inflation went up. And it didn't happen for years and years and years. And I couldn't work it out why. And now all of a sudden it has. So as you expand liquidity, ultimately, you do stoke the fire of inflation. So it can't continue indefinitely.
Well, yeah, I would say, it all comes back to China. Is our Gareth and which is our favourite topic of
debating point.
Exactly. So my riff on that is that the reason we didn't have the inflation post the financial crisis was because of the growth of China. The deflationary impact of the phenomenal growth of Chinese goods flooding Western markets and we've all got lots of cheap stuff as a result. And for some reason that I think will become more apparent as we go through this year, that stopped working. And the big question, is that a temporary phenomenon or a permanent one? And I'm beginning to feel it could be more permanent than temporary, let's say, but, could be well wrong on that. But, I don't think that can be ignored in this context, but we've suffered a big hit on inflation, and it does look in the short term, at least, or medium term, the next 1 to 6 months, it looks like it's heading down and could be heading down quite sharply.
Yeah. Should we talk about some other corporate highlights in the last week or so? We had a positive update from Gamma Communications, who've said that they're in line with market consensus expectations that had risen across the back half of last year. So they seem to be trading nicely and heading well into 2024 and still very cash generative. And they've launched a process effectively to work out what they're going to do with the high levels of excess cash they seem to be enjoying. So that's a positive.
That Gamma has been one of what I would say is sort of a strong cohort of mid-cap stocks that have not really put a foot wrong during the derating process that's gone on in the last few years. Don't think there's been any downgrades to numbers, certainly no profit warning or misses of estimates on their part. Yet, if you look at where that share price is from the high, it's about 50% of the high, the pre-COVID high. Yeah. And continues to deliver, generates cash. Yeah, just real interesting one, that I think.
Yeah, no, it's a phenomenal story, and it looks like there's still more to come across the rest of 2024.
Yeah, no, it was a good update. Okay, we'll call it a wrap on this one. Thanks both for your time, particularly Scott for giving us that great run through on market indices. Who would ever have thought market indices could be so interesting? Thank you, Scott, and look forward to talking to you again soon.
Great, thanks very much. See you.
Brought to you by Progressive Equity.